Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Lynn & Associates with your agriculture update for this Wednesday, the 31st of May, the last trading day of the month, 2017. We're about 1:30 p.m. Central Daylight Time. Well, as you can see, we still have a very choppy situation. Give you an example. Corn takes off to the top side, comes back, still did a nice job of closing 5 higher, but 4 cents off the high, almost what it gained. Then we get to the wheat market, which really rallied up to a high of 436 1/4, only to give it all up and close lower on the day. Meal pretty much unchanged, in the bean market, well, just sort of hanging here. Cotton hasn't had much of an up move since it got to 87 cents and has been selling off ever since then. The sugar market, I see it still under selling pressure. And if you're taking a look at any of the energy markets, by the way, because it does affect corn for the ethanol and so on and sugar, well, you see they are still under selling pressure. They're bouncing a shade here, and I'm of the opinion the market is looking to see where the support comes in. Of course, we're all waiting today on the API report, and then of course we get the EIA report tomorrow along with natural gas usage. So the markets will be looking to see if do we have net draws on those products. So in the soybean market, I'm still going to argue we're in a down thrust, especially on a weekly chart as we've gone now from 980.5 to a new low made today of 909.5. Market's still pushing to the downside. When you look at the daily chart of closes only, you've gone from 976 1/4 to the low just yesterday of 912 3/4, and you got a minor bounce today of about 3 1/4 cents. But still a market that is pushing to the downside. And you see this in the chart as it's coming down like that, and you see it even better. And this is the point I always love making. This indicator that I developed years ago, I created it at that point, probably 20 years ago, because I wanted my son, who's now in his 30s, to have an idea what a trend is, and if I could explain it to him, I could explain it to other people. Since then, I've taught it to people. I've engaged children trying to do this with one of my friends who has a school that teaches trading, believe it or not, in the Chicago public school systems, to kids as young as 8th grade. And then brings it on through high school and so on. We even did coloring books together for younger kids to teach them the ideas of trading. And as you can see, it's lower highs, lower lows, and until you take out 952 1/4, that pattern is intact, and that means a downtrend is in place. What I then do is I filter it with the 18-day average of closes. When a market is under the 18-day average of closes, I define the market, if it's under it, to have bearish bias, over it bullish bias. That filters the swing line. An example, I just said 952 1/4. Well, this red average is going to drop tomorrow again. How do I know it? Because if it's an 18-day average, these numbers here will replace numbers back here, and that's going to drive it down. So on the rally back up, the resistance doesn't have to get there, but if it did, that'll be the new resistance point. As it is right now, if the market rallied to that number, well, it would have taken out that rally high. Now that average is going to get under it, which reinforces the bearishness to a degree in the market. If you take a look at the lower bands in black, that are the dashed ones, they're called Bollinger Bands. And the idea behind them is the market will trade within them 95% of the time. It's called an algorithm, and it's built to do that. Well, as you can see, today's close is 916, and you're going to close over the lower Bollinger Band, which is 915 1/4, by just enough that you had 2 days in a row under it, and you're back over it. This is also called riding the lower Bollinger Band. That's quite bearish. As we take a look at the slow stochastic oscillator, which is a momentum oscillator, the theory here is that momentum leads price. And in this case, what's happening now is momentum's not only leading price, but if you look at how many days the blue and the red lines, the blue's called the K, the red the D, are spending under 20, they've got 3 days in a row. Anything that's 3 days in a row or more takes the market and locks it into what we had here, a bearish trend. Now, how long it stays, we'll judge with the market. But when that occurs, often prices move lower. In this case, because you're hugging the lower Bollinger Band, it's got even more bearishness to it than normal. Same thing's taking place in the meal, and notice it doesn't even bounce yet to the upside. You may get that in front of the weekend coming up because weather in the summertime in the grains is ultra important. It's going to give us an idea, can the farmers get that last bit of corn replanted? We've heard from some of the farmers we deal with, 3 replantings already this year in wet areas. Will they keep going? Will they take the crop insurance instead? Can't answer all that for everybody. Every area is different. Soybean oil now locking itself into that Bollinger Band and falling down. So without a bounce of any size in the beans or the meal, where's oil going to go? It's just a byproduct of everything. We then get to the corn, which is a whipsaw market. I want you to concentrate on the 18-day average of closes. You tell me how many days it hits it out of not hitting it. It's almost every day it's hitting it. That's a sign of a market doing this, and if you're trying to trade that, the only way that I've ever learned to do it is a contra-trend trade, which makes no sense to me mentally because when it starts trending, you're the wrong way in the market. So what do you do in a market like that? Who said you have to trade it? That's the first thing. I leave it alone. Even momentum is just flat as can be. In the wheat market, you try to break the other day, failed, okay? Now you're coming back. Here's what's really happened. On Friday, you have an outside day up. Normally, you do not take out the low of an outside day up within the next 2 trading sessions. In this case, it did. It just fell apart. Today, the market gives you a rally back up from the lows of yesterday at 29 to 36, and by the end of the day, it's right back in trouble. There's nothing here to do. You've got a higher high and a lower low. What do you do with a trend like that? In the sugar market, you're oversold, not trying to develop that momentum that locks in the bear trend against the lower Bollinger Band. This is where I think the pros are taking some money off the table. Now, the fear, of course, is if you take all the money and the market continues down, you got a problem. It's bearish, oversold against support. In the coffee market, one more time, we go to this 18-day average of closes and we fail again. Look at how many times this has been happening. That's why I call that 18-day average the line in the sand. It so often is the zone the market tries to get back to, and what it does there for me, I think of it as a pinball. If the market had been a downtrend, it gets to it, it's a reset. Now the market's looking to see what's the next thing that's going to happen. In the cocoa market, we have a pattern of a higher high that makes a lower low and gets a bounce back up. The market is not yet overbought. It is still pointing to the momentum to the upside. If it wants to extend, 21.17 is a possibility. But because the 100-day average has been giving this market fits each time it runs into it, I wouldn't be surprised if the pros are taking money off the table up here and saying, okay, came back up, let's see what it can do afterwards. In the cotton market, here's that market, goes from 87 cents down to 77.10, gets a bounce, pulls back down. If it can get up and over 78, 72 and close like that, I think this market will have said enough on the downside. That does not mean it's bullish. It's just saying it's enough. On the other hand, let's count how many days we have under 20. Today, both the K and D lines are under 20. Yesterday, they were both under 20, and the day before. You have an embedded reading. Now, if the red line gets lost over 20, back over it, then I look for that 18-day average. Let's assume it doesn't. There's nothing to stop this market then from working lower. We know the battleground has been in the past this 100-day average. You've now got 3 days in a row under it. Which way does it pop? The odds favor to the downside until you lose that embedded reading. In the cattle market, you got up today to 121.90, taking out this 121.65. What's the picture you see here? Because you should look at it. You should start seeing the sideways action that's developing out of nowhere all of a sudden. This big run ended, and now the market is regrouping. Keep in the back of your mind that in July, the first permits are supposed to be issued for us to ship direct cattle. to mainland China, not going through Hong Kong, that gray situation. Now, do the permits actually get issued then? I can't tell you. But I can tell you this market in the far back months is looking at a brand new source for putting out their cattle. And that hasn't happened in over a decade when we had that mad cow threat. And by the way, let's thank President Trump every now and then. He's the one that got this lifted. And the August feeder chart, you got a lower low, a higher high. You ended the downtrend today, but like this market, are you really trending? I don't think you've got any trends going in the cattle. It's looking for them. The market that's in a runaway mode are the hog markets, and I know people probably aren't paying attention to it. I've been writing about what our firm thinks in our newsletter, and they keep writing that this market, something big is brewing here. It doesn't give you more than a couple of dollar break, if that. And it just keeps making new highs on this move. Very, very important. Now, I keep mentioning my newsletter and what I do. If you haven't had 20-day free trial access to it and you watch my videos all the time, why haven't you done it? If you want to subscribe, you can if you go to our website, by the way, and just type in IRA 20. What will happen is if you subscribe to my research as a payer, just type in IRA 20 in the coupon area. You'll get $20 off the first 30 days. The subscription, if you don't have a trading account with us, is $60 per 30 days. That makes it $40. You can then decide what you want to do. But as a minimum, if you haven't tried this, you can either call us at 866-973-2077, www.iraepstein.com. You can also click under here on many websites. It'll say click here for IRA's free offers. And of course, click up here, and what you get on the icon from YouTube will take you right to the area you have to be. I want to remind you on something. I do that all-important morning subscriber video that you don't see on YouTube or anywhere else. And that's where I set you up for the day's trading ideas. You have a great day. I'll see you all later.